Welcome to the bonus section of hiddenmoney.com. Kevin and I just had the honor and privilege to interview Gib Irons, one of our good friends, great client, and someone who is just doing an incredible job of leveraging the hidden money in the tax code to grow his portfolio and grow it well. Such an awesome client, isn't he, Kevin?
Yeah.
Because he has all of the material for us to work with,
Yeah.
and he listens and follows through with it. He's not letting the tax tail wag the business dog, but it's also just kind of fate that he comes into our office when he's got 14 long-term rentals that they have not accelerated the depreciation on, and his wife wants to get into real estate management. That doesn't happen every day, does it?
No, he's a very unicorn, but pretty sure that someone else out there could be in a similar situation to leverage real estate holdings against your active earned income, the tax savings on long-term real estate. Because when we're talking anything real estate, you really have two options in the tax code. Now, it varies in actual market, but in tax code, we're talking long-term real estate and short-term real estate. Those are two different beasts, two different code sections. So you got the same code section, different subsections of that code section.
Yeah.
So when we're talking long-term real estate, which is multifamily syndications, the duplexes, condos, something with more than your average lease time of 7 days. If it creeps over 7 days average lease time, which is going to be your monthly rental, your annual leases, things like that, it's a long-term rental. In order to utilize long-term real estate to offset active or earned income, your W-2, your self-employed income, which is the goal, which is more than likely where your tax problem is, you have two things you have to do. Number one, you have to be a real estate professional by IRS standard. All that is 750 hours of qualified real estate activities, and over half your working time is in real estate. That "and" is really big. It's because that will eliminate a lot of people right off the bat. Because Mike, you and I, we're full-time CPAs. If I just wanted to really just overkill it and get 750 hours in real estate, over half my working time is being a CPA. So even I could get 750 hours, but I'm not going to qualify. So if
Nope.
I bought long-term real estate, it's always passive for me, unless my wife, who is stay-at-home currently, let's say she wanted to get into real estate. We filed jointly. So if one spouse hits real estate professional, now all of a sudden on a joint return, real estate losses can offset my active earned income. So in that instance, my spouse would have to get 750 hours and over half her working time in real estate, which is easy because she has no formal job. So that's the strategy we're utilizing, which is where we could really take high income earners, doctors, lawyers, CPAs, engineers, whatever your call is. If you're making significant money, then we could utilize long-term real estate to offset those taxes.
Boom, and hidden money starts appearing and falling from the
Yep.
trees.
As long as your spouse is on board. But let's say you're a
Yes.
high income earning real estate agent. You got the tax code. It's right there for you. If you're in construction or real estate development, some sort
Hold on,
of
let's
real
go
estate
back to the real estate agent thing. And it just brings back a memory of yet another call with a prospective client I had last week. And she was a realtor, and they had a property that she was managing. And then they also had a bunch of syndications, but they weren't taking any active depreciation. I looked at their return, and their prior CPA put it all as passive. So let's there's so many people out there, not just realtors, but again, I'm focusing on this realtor now. She was told that, oh, it's all passive to you. You're a real estate agent. Yeah, you manage one property by yourself, which after we unpacked it, she was a material participant, the material participant in that property. She was the only one managing it. That opened up the 15 syndications. They're getting K1s and a lot of depreciation. That opened it up to being treated as active, not passive, unlike their CPA previously reported it, which is just awesome. It's like the promised land. But talk to me a little bit about why, in her case, she was able to take these K1s from passive LLC investments she made in multifamily housing. How does that depreciation get freed up and no longer, why is it not considered passive? She's a passive investor in those LLCs. How does that work, Kevin?
is actually a grouping election. So this is the really cool thing about real estate, especially long-term real estate. Now, short-term is a different thing. You can't group short-term real estate because that's a different rule. But When you're talking long-term, multifamily, duplexes, condos, those long leases, then as long as you are a materially participating real estate professional, you can actually make an election to group all of your like kind long-term real estates together for material participation purposes. So what that could look like in this instance, let's say you materially participate in a local long-term rental property that you manage. You hit the material participation test, you hit real estate professional designation. Now let's go say you get with Gibb and get into a multifamily syndication. You're not involved in that. You're passive. You're not running the fund. You're not running the property. You're strictly a passive investor. Well, we make that election, that grouping election, and you can take the syndication investment and group it with that long-term rental property that you are managing. And now everything in that bucket is now active. So the depreciation that's kicked off from the multifamily syndication is now deductible instead of passive.
Boom.
So it's terrific. Yeah, it is hidden. Like you wouldn't believe how many times we see that opportunity missed or they don't even know about it. So just making that grouping election could save a lot in tax.
It's incredible. And we've seen that sadly a lot. I'm not sure why that gets missed so often by our colleagues out there. It doesn't get missed all the time, but we've seen it get missed a lot. And in this particular case, I don't think you've had a chance to review the prior returns that I looked at for this new client of ours, but they had, again, 15 syndication investments. Now, some of those are 2022, so I think it was only 9 for 2021 and prior. They've already filed a return. There's over $150,000 of losses generated by accelerated depreciation, net losses from those syndications that were recorded as passive activity losses. So when we amend those returns, these people are going to show new taxable income, amended taxable income, $150,000 or less. They've already paid the taxes on that. They were assessed the taxes on that because they weren't allowed to take the losses when it was considered passive, but it wasn't passive. And we're going to amend these returns for this client. I love working with new clients, kicking the ball off like this. Hi, nice to meet you. Can I see your returns? Whoops.
Yeah.
Can we redo those returns? Yeah.
Yeah.
And then they're looking at a $50,000, $60,000 tax refund that they had already paid and they shouldn't have. And thank God the statute of limitations hasn't expired.
Yeah. And there is a negative component to the grouping election. With the IRS, there's always this balancing act, right? Like you're going to get a terrific tax savings on something, but at the end of the day, the IRS is going to try to get their money. And our job is to make sure they get it as late as possible, if at all. So the negative component of this grouping election is all the prior year losses that you've incurred when you make this grouping election aren't freed up. They're stuck as passive losses. So making this grouping election and making prior year passive losses in the active bucket don't make those losses active all of a sudden. They are stuck as passive losses. So now what happens is since you've grouped the activities together and you dispose of that rental property that had all those prior year passive losses tied to it, typically when you sell a passive activity and it had losses attributed to it, those losses are freed up on disposition. But now, since they're grouped together in the activity, you can only free up prior year passive losses when the whole activity is sold. So now you've actually tied up these passive activity losses for a substantial amount of time until that whole activity is sold. But if you get on the front end and you don't incur these passive activity losses, and we start the portfolio off right by grouping everything, then you don't have that issue. But they could have some negative tax effects if you're coming late to this and you do have those tied up passive activity losses.
But you can have multiple groups. When you're doing grouping, you don't have to group all of your syndications into the one group. In this case, none of the syndications are older than 2 years. So all those years are open. And again, if the statute of limitations is passed, our opportunity with this client would potentially have been eliminated, like Kevin was saying. So once you generate a passive loss, it's always passive. Once you generate an active loss, it's always active. Once passive, always passive. Once active, always active. But there's the ability to go back and amend a return if the statute of limitations is still open and say, no, we are grouping on this amended return these losses from 2 years ago. So they're basically being removed, or you're basically saying, hey, we're not keeping these as passive. We're actually calling these active in the year they were generated. So in their case, they're going to be able to take all the actives. But if it would have been 2 years from now, we'd have been stuck because one of those years would have been statuted out.
Yep. And we'll get into this. So if you like all this bonus content and you like what you're hearing and you want just more detail, there's a lot more meat on this bone. What we can do is you can go to a link below, which will actually take you to what we like to call our school. And here at the school, I'm going to go into detail. Mike and I will go into the details of what code sections are. How do we do this? How do we stay safe doing this? We're going to walk you step by step through these tax strategies that we're going over, and to make sure that we qualify for them, but that we're doing them safely, and then that you can take these aggressive tax positions, but stay out of trouble too. So that's what school is going to be all about, is making sure that you have the education available to you. And then once you have that education, you can call on a professional CPA, whether that's us or someone you already work with, then to enact these strategies that you've been educated on. So we really want to encourage you to check out our school. But we'll always be giving out bonus content and our weekly podcast regularly to give a high level overview of tax strategies out there and tax law changes.
Yeah, we understand you, our audience, don't love the details, the tax code sections and
No.
treasury regulations or even the case law, but it's hard for me to understand why you don't love that, because it's one of the coolest things in the world to me. But we're trying to isolate you from that, insulate you from that. And then if you want to get more detail, which ultimately, if you want to put some of this stuff in action, you need the detail, or you need a tax professional that knows the detail and is going to navigate it, help you navigate it right, legally and responsibly, and with the ability to withstand any IRS scrutiny you might receive. So we'll try to keep it big. It's high level on the actual podcast. Bonus content, we get a little bit more in the nitty gritty. But man, I can't wait for that school content where we get
Yeah.
into the nuts and bolts. It's going to be good stuff.